Hello, I'm Chauncey Joyce. I'm a finance professor in Cluster. This video is meant to give you an introduction to your finance template, which you'll be using to aid in your Project 2 financial requirement. Let's start this video with a quote from Jean-Marie Eviat. It's very common to drown in the details or be attracted to complexity, but what's most important to me is to know what 3, 4, or 5 major characteristics of the business really matter. I see my job primarily as asking the right questions and focusing the analysis in order to make a decision. We're going to keep this quote in mind as we go through this template. We're going to try to find which assumptions, which characteristics of your business that really matter. There's generally only a handful. Jean-Marie calls it 3, 4, or 5. So we'll have a set of assumptions we make for your project. If those assumptions are really driving a lot of value, we're going to need to double click on those and really understand them. That's where we will focus the analysis. So let's start with the template. This is a one-page template. It's meant to put every financial number into one set. We can see all of our variables and inputs here. And there's a brief description of the assumptions and the sources of your information. Next, we have a pro forma income statement projected 5 years out. Notice we start with sales and end with net income, and we have the years across the top. This will feed our total project cash flow. Notice initially we have investments of net working capital, including cash, and capital spending. This will then feed project net present value. And you've been asked to assume a terminal value that is 4 times year 5 EBITDA. Think of this as a measure of what your business will be worth in horizon or in terminal value. The last section has project decision criteria, including payback, net present value, internal rate of return, and then an ultimate decision whether to accept or reject your project based on how much value is being added. Let's go back to the variables and inputs. So Jean-Marie tells us to focus on the 3, 4, 5 major characteristics of the business. We may not yet know what those are. My advice to you is to fill this out with the most reasonable assumptions you can find. This will require some research. For example, volume, price, cost per unit, SG&A, your marketing, MIS, other operating expenses. Your interest expense we will come back to on the interest expense tab included in the next tab of this Excel document. Year 0, property and equipment, and a tax rate. For now, assume 34%. There is certainly a more robust way to calculate this, but it's probably not going to be determined to be one of the 3 most important variables for your analysis. Not at this stage of your project. Okay, let's go to our appendix tab. Each of these has a section. You may need them, you may not. However, I've tried to put them in order, so please start with this template. Year 0 startup costs and investments. Provide background to any year 0 outflows. These are all the cash flows and all of the investment that you need before you can open the door to your customers. Before you're able to run your business, you need to invest in all of these items. So these are important because they're year 0. They're typically undiscounted direct impacts to net present value. So this can include capital investment, buying a building, renovations, net working capital, such as cash on hand, any inventories. All of these things in year 0 are necessary before you can open your door to your customer. Any expense before you're ready for business. So let's look up here while we're still at the top of this screen. Any gray cell is a required assumption. For example, you're to assume a cost of debt is 6% and that 30% of your funding comes from debt. 70% comes from equity. And we're going to assume a tax rate of 34%. If you'd like to refine this, you can visit your Ross, Westerfield, and Jordan Fundamentals of Corporate Finance textbook and find this on page 29 through 32. So next section is cost of capital. If you remember from your finance course, cost of capital is the discount rate you're going to use when calculating net present value. I'm going to quickly switch back to the template so you can see where this will feed. Net present value is calculated as the discounted cash flows from all of the cash flows that are going to occur in the future. So all of these have been discounted by your cost of capital. In this case, it says 1%, but that's only because we haven't filled it out yet. So if we go back to the appendix tab and go to cell B28, we know that it's going to pull from WACC. So in this case, we're going to use the weighted average cost of capital to determine your cost of capital for your project. Since this is the only project that your firm has, this is an appropriate use of weighted average cost of capital. The only item left for you to fill out, which is yellow, meaning it's an input, something you need to put into the cell, is the cost of equity. And this could be found numerous ways. It could be a venture capital estimate, meaning how much might a venture capitalist expect to earn in return if he invests in your idea. So generally, this is an extremely high number because it's a very risky scenario. You're a new business and you're looking for funding, and that funding is going to come from an investor like a venture capitalist. I would not be surprised if this number was anywhere between 25% and 50%, but that's up to you to determine, and it is based on the riskiness of your idea. Or you could use the security market line, CAPM, or the Gordon dividend growth model. All of these are acceptable ways to come about a cost of equity. Let's next look at volume. You've been asked to run several demand scenarios. This is how we're going to integrate this into your financials. But ask yourself, how will volume grow over 5 years and what support can you give? So you may have several different sources of information, primary and secondary. So perhaps primary comes from places you've called and found out what their volume is. So you have daily volume, and you've extrapolated that based on 365 days open per year. So you have two different places. If we take just a simple average, we can come to an idea that this business has 7,300 volume. We don't know what units are. It's not a real business. It's just an example. And secondary. Perhaps you use local population and some kind of number to estimate walk by. Ultimately, you're only going to have to pick one of these numbers, the one you're most confident in, the one you can provide the most support for. This is the cell that will then feed the volume in units on the other tab called template. So notice any cell that's green feeds a variable in an input. So this 7,300 will feed the template here. Actually, in this case, we've assumed this is year 5 going volume. So all of these estimates you have are likely to be going volume, meaning once you're established for 5 years, that's the full volume you can expect. Think of it this way. If you call up places that already have a comparable business idea to yours, it is very unlikely that you're going to see the same volume estimates in your first year of business. You don't have a customer base yet. They've been open for probably 5 or 10 years, so they have much more volume than you will probably have. So in this case, this has been set up to say we expect year 5 volume to be 7,300. But before that, we've assumed some kind of volume growth, in this case 15%. So 15% per year, ultimately leading up to a going volume assumption of 7,300. This is an assumption that warrants a lot of insight and analysis. This is what determines top line. Price times volume will equal sales. So understanding this number is very important. In this case, I assumed 15% per year growth until we reach a going volume of 7,300. Next is price. Once we have volume, the number of units, times the price per unit, we can arrive at sales. Let's look at this case. This is the price of the average transaction. It doesn't mean every consumer every time will buy these products or services. It just means on average what we expect a customer to use. Let me use an example of haircuts. This is what we did in the summer cluster project. Let's say every consumer that walks into a barbershop will pay $9.99 for a haircut. And half of those consumers will buy a shampoo for $4.99. And a quarter of them will buy a hair gel for $7.25. And again, a quarter will buy another product, and a tenth of every 10th person will spend $49.99. Say that's some kind of tanning subscription. So this means on average, we expect every customer to spend $20.54. This is taken as the sum product of these two columns. We could simplify this if we wish to. So if everybody buys one haircut, one shampoo, or every other customer buys one shampoo, and every fourth customer buys a hair gel, etc., we get to an average expected transaction per person of $20.54. This, since it's in green, will feed our price per unit. Let's go back to our template tab and see where price per unit is. This is where we have 120. Next, just set up just the way we did price is the cost for the average transaction. Notice we have the same units here. 1, 1/2, 1/4, 1/4, 1/10. So if we had price up here for product 1, and feel free to specify, that's going to be much easier if you call this haircut or whatever your products are going to be. So notice the cost for the haircut is $9.99. Sorry, the price of the haircut is $9.99 and the cost is $5. We do this for each product that your business is going to offer. And as you go through this, list all of the assumptions, list all of your sources. So for example, was this competitive benchmarking? Perhaps these were the result of the businesses you called. Place A, place B in this example. Were they your own estimates? Were they primary data? Did it come from an article? Where did it come from? Can you triangulate this data? List all of those assumptions in this section. Same with cost. Where did you get it? In this case, this is just taking from the summer semester when we looked at beauty and grooming, and we have Sephora benchmarking, perhaps estimates, primary data, SEC filings such as 10K. List any assumption that led to your determination of cost per unit. Next is depreciation expense. So before you can compute this, we need to provide a description of the property and the equipment that you're going to be depreciating. And how are you going to be depreciating it? Straight line, macros, etc. This has been set up that straight line is fine. It's a fine way to start. Again, we're trying to input the assumptions that we know about your business, and generally we only know 3 weeks worth of data. So if we revise our depreciation approach, it probably will not be determined to be one of the 3 most significant levers in your business. At this stage, it typically comes out to be volume, price, cost, and initial upfront charges. But if depreciation is a significant driver of value for your firm, then please investigate what the most appropriate way to depreciate your assets will be. So if it's property, we put in our initial investment, and then we have to calculate each year's depreciation. And this should bring flashbacks from your finance course as well as all of your accounting courses to date. Then the total of property and equipment. There could be other assets as well for your business, in which case you'd need to add a little bit of additional complexity. The idea is now that these green cells will feed depreciation on your template. You can see depreciation expense comes from the appendix tab in these cells. Notice this is going to appear on your pro forma income statement. It's an expense. List all of your marketing details here. What are your marketing plans? Everything should be detailed here so that if your marketing professor looks here, he has a generally good idea of all the costs you've assumed. So add rows in here as you need and detail those out by year. As with MIS, your MIS professor should be able to look here and see all of the assumptions about the systems you're going to use. Again, these you will need to link towards your inputs, which will feed all other calculations. Those are here. Marketing and MIS. Next is your interest expense. So remember above when we were looking at the cost of capital, we said some of this funding is going to come from debt. So in this case, we have a template that says we've assumed 30% of property and equipment and net working capital. Remember, net working capital is the difference between current assets and current liabilities. So one of the required assumptions we had above was that 30% of your funding comes from debt. You have to pay interest on that debt. So at 6% APR interest, this is going to set up to automatically find a payment for you. This is very similar to all the calculations you've done in your finance courses. Number of periods with a periodic interest rate, with an original loan amount to determine a payment. Next, each payment, although it's $9,702, each payment is comprised of both principal and interest. The portion we're going to use for interest expense is going to be in this column. So notice, the original loan amount was $220,500. This was assumed to be 30% of property and equipment, which we can see here. Again, there should be details on this number on the previous tab. And net working capital. Think of net working capital as also some of the cash you need on hand. It won't be surprising if in year 0 or even year 2, you're still not a profitable business, meaning net income is negative. If that's the case, you're going to need to consider taking out more cash because your employees are going to be expected to pay. You're going to have to pay utilities. You're still going to have to buy inventory. So if you're not profitable, you're going to need to take out a larger loan in year 0 to pay for losses down the road. So the idea is once you've set up the original investment amount, this will take 30% of it. And perhaps that number, this number could be higher. It depends on your business idea. So these cells are calculated by quarter since we have a quarterly interest payment. So if we notice these 3 cells of interest expense, they sum up to, we can't see the bottom of the screen, but they sum up to $12,649. So if we go back to our template, we'll see $12,649. This is C132 through 135. 132 through 135 of column C. If there are other sections you need to detail, please add as much space as you need. But again, the main idea, and let's look back at Jean-Marie Eviat. It's very common to drown in the details or be attracted to complexity, but what's most important to me is to know what 3, 4, or 5 major characteristics of the business really matter. That's our job here. What are the 3, 4, 5 major characteristics that are really moving the lever for your business? Those are the items that end up getting pulled into the report section. Otherwise, the template is going to stay in the appendix. But highlight these 3, 4, 5 major characteristics. You have a template that provides an input section. You list your assumptions. Most of these assumptions need to be supported in another manner. That's what the appendix tab is meant to do. We can add support for each of these assumptions. You have year 0 startup costs, your cost of capital section, a section for volume, a section for price, a section for cost, for depreciation, for marketing, for MIS, and for interest. If one of these items is really moving the lever, and by lever I mean net present value, the value you're creating with your idea, if one of these levers is very sensitive, meaning it results in a wide range of net present value if you change it, you need to substantiate it. It needs to be analyzed further, just as Jean-Marie recommends. So ask the right questions and focus your analysis in order to make a decision. Find those levers, if it's volume, if it's price, etc. Here are some other tools that are worth considering. Are you using financials to make decisions that add value to the firm? Finance is all about decision making and firm value. Make sure you're focusing your analysis on items that will add value. Can you tell the story? You're going to need to persuade professors with very different fields. But if you tell one compelling story, they can all get on board. Can you effectively persuade others to make a decision? Can you summarize the main points from these tables within your report and presentation? So notice not all of this template will be put into your report, but any of the 3, 4, or 5 major characteristics, those should be put in the report because that's what's delivering value. Those are the items that are making your idea add value or not. Do you have a recommendation to accept or reject the project in the executive summary and the report? The executive reading this would want to know, is this a project that will add value? So tell that executive up front. If you need a refresh on some of these capital budgeting decisions, feel free to refer back to Chapter 10 in your Fundamentals of Corporate Finance book by Ross, Westerfield, and Jordan. Is your template organized, clear, flexible, and accurate? I believe it has been. It's organized. We have everything in its own place. We have pro forma income statement, project cash flows, which are all fed from different assumptions. Is it clear? Are your assumptions detailed? Do they have inputs and assumptions clearly listed? Let me go back to the appendix. So for example, if you were to hand this in your appendix and cost of equity you've determined was 45%, are there details here on how you got to that? Flexible means it's a template that we can use different assumptions for and quickly get to a new answer. So if it's determined that volume is actually 5% higher, if you made all of these numbers 5% higher, we could very readily see a change in net present value without having to manually recalculate all of these calculation cells. And is it accurate? Do a gut check. There may be a mistake in here. Look through each line. Check that it reconciles with what you understand from your finance courses, because ultimately you're in charge of this template. Are you prepared for questions? Sensitivity analysis. This is a very powerful tool. And if we review Jean-Marie's quote, sensitivity analysis is going to be what we could use to help us identify the 3, 4, or 5 major characteristics that really matter. These are the drivers of NPV. If you change that assumption, net present value changes in a sensitive manner. How can you make your assumptions and sources for key drivers more robust? Well, the way to do this is likely to triangulate the data. So you could get this from multiple articles, from interviews with businesses, etc. Do you emphasize the key drivers of NPV while performing analysis and recommendation? This is an important part to include within your report. What are the key drivers that are moving net present value? That's what your decision maker really wants to know. What are the levers? And then next, what can I do to make those levers more impactful to my business? How can you make the project bigger? So you're going to have a base case financial statement, but then there are things that you could do to improve your idea. They may not go into your net present value right now, but they are highlighted as future sources of growth for the firm. How can you mitigate project risk? This is dependent on your own idea and the research you've done behind it. Now, if you'd like to go further, you can even do a common size income statement. Remember, that's an income statement that has been scaled according to sales. So every line item is presented as a percent of sales. How does your company compare with publicly traded companies? Do a gut check to see if anything unrealistic jumps out. You probably will not have the same operating efficiencies as some of these large publicly traded firms, and that's okay. It's just meant to see, are these numbers in line, and recognize that we probably won't have the same efficiencies yet. Net present value is a graphical representation of net present value and interest rates. This is an optional exercise for you to consider where your project's costs and IRR lie. You could ask yourself questions of renegotiating the interest rate on a loan. Can you articulate risk and return relationship for your project? And perhaps most importantly, can you articulate the practical meaning of cost of equity, cost of debt, and cost of capital? I'm going to go back to the appendix tab and show you what that question is getting at. In this section, once you fill out a cost of equity, you're going to have a weighted average cost of capital. This will be the rate by which your cash flows are discounted to the present. So, can you articulate what cost of equity means? Be ready for this question. How did you get to it? And scenario analysis. I recommend you be very careful with these because best case, worst case are very unlikely to be realized all at once. A sensitivity analysis can highlight which drivers are changing, but a scenario analysis may include all of the best and all of the worst, which can be misleading if they are very unlikely scenarios to occur. So I hope you found this template useful. I want to reiterate again, the purpose of this template is for your Project 2 financials. We recognize that we probably at this point only have 3 or 4 weeks worth of knowledge on your company. This template's meant to highlight what assumptions you're making and where the most value is being created from your business idea. This is not an appropriate template by the time you get to a launch phase, but for an early preliminary check of whether we're adding value or destroying value with your business idea, this can lead to more helpful decision making. Again, focus on the 3, 4, or 5 major characteristics of the business that really matter. If those characteristics really matter, provide a lot of detail for them in the appendix. Justify them. Hone them in. Understand them, because that's what's really driving your business. Once you understand those better, you're in a better place to focus your analysis in a way which will make a decision. Ultimately, the decision we're looking for right now is whether to accept or reject your idea. I hope you found this video useful. Good luck.